Hello and welcome to KYC, a brand new show at NDTV Profit. In the fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of the companies that they invest in. KYC, Know Your Company, is a show designed to give you regular investors powerful, actionable insights into fundamentals of a single NSE-listed company every day. And today, we have in focus KEC International. Now, KEC International is considered as the flagship company of the RPG group. In fact, it is an EPC company with the key infrastructure sectors, which include something like power transmission and distribution, railway, civil and urban infrastructure, as well as renewables, smart infra, along with oil and gas pipelines, as well as cables. Now, in terms of the revenue mix, what we are looking at is more than half the revenues of the company will come from largely transmission and distribution. That's where the focus is. But moving in, about another quarter%, or rather quarter of your revenues come in from civil, and railways then contributes to 10% of your revenue. So this is largely your revenue pie when it comes to the business, that is KEC International's business. Of this, the most robust growth that the company has seen is essentially in its largest business as well, and that's, of course, transmission and distribution, and that's, of course, followed by something like a civil as well. Besides that, we do have, plenty of revenues coming in from oil and gas pipelines, cables, and others, but the mainstay of the business, as I've mentioned, is T&D and civil. Moving on. With that, I'm going to get in my colleague Anushree, who's going to join me in taking us through the companies that we are looking at and the various variables that we can keep an eye on. And of course, at the end of this particular segment of the show, we'll also rate the company in terms of how the financials have done. Anushree, thanks for joining in. Let me start off by talking about the income statement. Now, overall, it certainly has had a very good growth over the past few years. But to talk to you about the income statement, at least as far as the revenues are concerned, it's a near 20,000 crore company. Its EBITDA standing at around 1,200 crores. It has, margins in the range of around 6 to 7%, and its net profit, at least for FY25, which stood at, FY24 stood at around 350 odd crores. What you have to keep in mind in this case as well, if you consider the 3-year CAGR, we've seen a revenue of around 15%. EBITDA 3-year CAGR has been relatively lackluster. That comes in at around 2%. But overall, if you consider the performance of the company simply on the back of how things have panned out, at least as far as the top line is concerned, I would give this one tick, which is, certainly a green one, a thumbs up. But Anushree, what can you tell us about the order book, and what kind of thumbs would you give it for?
Yeah, Agam. So one of the very important metrics to determine the future revenue growth for the company is on its order book. Now, if you look at what the order book positioning of the company is, current order book stands at about 34,000 crore, and this also includes an additional L1 position of about 8,500 crore. This is as of September 24 picture that we are looking at. Year-to-date order intake for the company has been on a very stronger side. We are seeing up to 17,300 crore of orders over here, which represents about 75% growth. And the company had given a guidance of about 25,000 crore of order inflows that they expect over FY25. So they've achieved 69% of this. So a very strong trajectory, especially from H2 onwards that we are looking at. But even if you look at its last 3 years order book, 23,716 crore in FY23, which then moved to 30,000 crore of range in both roughly to FY23 to 24. So this implies about 1 to 1.2 times of book-to-bill ratio for the company. So that is what the order book picture is currently and in the past as well.
Right. Fair enough. And of course, execution is key. But I suppose the company is very regular in terms of the execution coming in. Let's talk about the balance sheet then. Of course, balance sheet is, again, a very important part of any company for that matter in the listed space. The good news in this case is that its debt to equity ratio is much less than 1. In fact, your net worth, your shareholders' equity stands at around a little over 5,000 crores, and this is as per the September 25 filings, and its gross debt is a little over 4,000 crores, but it also has cash worth around 500 crores on its books as well. So I would give its balance sheet a thumbs up as well, considering the space in which it is in. It seems like it's at a comfortable debt level. But Anushree, how about shareholding, and how does that pan out for the company?
Right. So if you look at, you've mentioned about the balance sheet ratios that are important to check, but even the return ratios on these balance sheet numbers as we speak, firstly is return on equity that we are looking at, that is about 9% is what we are seeing. And even ROC is a pretty impressive number over here, 24% of an ROC number. Do note that anything about 20% is on an attractive levels for this. So yeah, healthy numbers on the return ratios also that we are looking at. But yeah, let's talk about the shareholding pattern as well, Agam. Yeah.
Right. So that's as far as the shareholding is concerned. Again, all right. So that's your return ratios. But I'll tell you about the shareholding pattern. And of course, it's a well-held company. So while the promoters hold about 50% here, we're also keeping an eye on institutional holding, and that comes to somewhere around 13.5% for FPIs, as well as domestic institutions coming in around 26%, which means the public holding in general is just about 10%, which means that to a certain extent, KEC International also has a scarcity premium, considering the majority of the holding is all players who would tend to hold this company towards the long term. So that certainly is a positive as well, and I'd give that a thumbs up too. But that said, Anushree, I reckon it's done pretty reasonably well in terms of the kind of capital appreciation it's given.
Yeah.
And what about the dividend?
So if you look at how its dividend has been, I'll come to the capital appreciation part first. How shareholders' wealth creation is the most important aspect. Now, in last 5 years, if we see 32% of a CAGR growth that we are looking at in terms of their share price return, a lot of these gains we are looking in the last 1 to 2 years. About 80% of returns this 1 year the company has clocked in. Now, coming to the dividend yield part, 0.4% is what the company's dividend yield is. But do note that this is a high growth business. So a lot of its sources, resources, they have to invest for the future growth of the company. They even concluded a QRP just a few months back. So that is also an important metric that one should be tracking about. So this is on the capital appreciation and the dividend yield that we are looking at, Agam.
Sure, fair enough. And, overall, in terms of the street coverage too, it has a good amount of coverage. There's no doubt about that. There are, in fact, more number of buys. That's about 13 buys with about 7 holds and 4 sells. So, about 50%, nearly 50% of everyone who's covering this has, in fact, a buy. The only, perhaps a drawback would be that its return potential for now, if you take the consensus price target on the stock, is minus, about 3.4% minus. So it's largely more or less where it is right now, which is why I would give this a neutral. So that's as far as your overall performance and what the street view is on the company. And based on that, we give it a score of 6 thumbs ups out of 7. So certainly on a very strong footing when it comes to the company and the way things have moved, so far. But Anushree, let's talk about the strengths and weaknesses, threats and opportunities as well. And I'm going to actually talk about strengths first. Now, we do know that the company has a very strong order book. We've already told you about, that's robust visibility with respect to the order book that it has, and that's the reason why the company is also very confident in the way you could see the revenue span out. Also, we're expecting a reduction in working capital days as well as debt. And in terms of the weaknesses, well, for now, margins remain in the 6% range. That's something that the management has also acknowledged that they are looking to improve. They're looking to increase the number from around 6% to a number slightly higher than that. And, of late, we've also seen a little bit of slackness when it comes to performance from the railway sector. That's the other thing that perhaps weighs down on the company just a tad bit. But, Anushree, what about the opportunities and threats here?
Agam, I'll just pick up from the last point that you mentioned about the railways. So while railways, if you look at the last couple of quarters, it has been on the weaker side, but FY25 remains as a key to watch out for whether there would be a turnaround in this business as the management had indicated. So let's just put it in opportunities for now. But other than that, order pipeline remains on a very strong trajectory. 1.5 lakh crore is what they are planning in. So bids would be from that number that we are looking at. Other than that, now if you look at the government capex in the first half, it has been on the muted side because of the elections and other key factors playing in. So H2 would be a focal point for a lot of these infra EPC companies as we speak. So this would imply higher orders in the next H2 as we speak. So pickup in private and public capex is going to be beneficial for the company. But let's cover the threats also. If we look at Q3, Q4 of the last year's financial year, one of the problems that the company had acknowledged was the supply side pressures which impacted the transformers transmission business. So that is one factor that we could be watching out for. Another that is labor shortages that the company was facing. This might be on the count of election which had taken place in the previous quarter. So how this would pan out is another factor that should be considered. So Middle East, there's also these Middle East crisis which had led to more risk for the business. That's what led to the supply chain issues. So these are some of the threats that we are looking for the business. This is on both the international and the domestic side that we are seeing.
Fair enough. Anushree, thank you so much. That should give us a good roundup of how things have fared for, well, the company, and of course the opportunities and threats, some strengths and weaknesses here. So once again, Anushree, thanks for getting us those insights with respect to how the company has fared so far. Let's take this conversation ahead with someone who in fact tracks the company. We have Amit Anwani, research analyst at Prabhudas Capital, who joins us on the show right now. Amit, thanks for taking the time out. You know, what we're looking at is, right now, the management has suggested about 15% revenue growth going in. They're seeking to improve their margins to a number which is higher than 7% overall. And they have a reasonably strong order guidance as well. How are you rating this company? What are the pros and cons as far as investing in this company goes?
All right, thanks for having me. So I think first of all, you guys have broadly discussed. So for any EPC T&D company, very important thing apart from the P&L is definitely balance sheets and cash flows. And the company has been facing some challenges post-COVID with respect to their subsidiary facing losses because of the high material cost, and that was not they were not able to pass through. There was one, then Afghanistan challenge came in where they got stuck with some cash flows. I think still 200, 250 is still there. And then the railways where the retention money milestones were higher. So again, they're focusing on closing the projects quickly in railways business and have been going very cautiously. So for me, we have been giving hold rating about 1,000 target price and multiple of 18x. The reason being neutral in the past is the cash flows and the margins also not improving. And but I think some changes have happened of late in the recent time. The QIP money which came in about 850, 900 crore can substantially improve the balance sheet. They are at about 5,000 crore debt plus acceptances that can go down to 4,000, 4,500 crore. So there is one important thing that can actually reduce the interest cost to sales, which is now keeping at about 3.3, 3.4% versus the average in the past of about 2.5%. So that drastically can improve the PBT and PAT there. And second important thing is that for me now, all these cash flows might start coming. Railways, they are going slow, and they're expecting that a few of the projects where they did see some delay might get closures and get completed, and they can able to get 600-700 crore cash flows from there. So I think definitely H2 might see cash flows improving, and margins will improve sequentially. I think they have been keeping this 5.5-6% margin almost from 10 quarters now. And I think the key to margin improvement definitely would be the domestic T&D orders, which we are seeing now started coming for many other companies also, and KEC also highlighting that there's a large pipeline for domestic T&D as well. So I think that can change the things from here. Yeah.
Amit, I just want to understand, if you consider the sector as a whole, where does KEC stand with respect to its peers? I believe its most like-to-like peer would be something like a Kalpataru transmission, and please correct me if I'm wrong, but are there any other opportunities? And also, in terms of valuations going forward, where does KEC stand in that particular matrix?
Right. So, as you rightly said, comparable to Kalpataru definitely directly. But having said that, I think the overall T&D space, which is now developing in India after the muted transmission capex for good 3-4 years impacted by COVID and some slowdown in project finalizations, is now picking pace with the ambition of government of integrating 500 gigawatt renewable by 2030. And then a lot of transmission infrastructure and capex is going to happen in next 2-3 years. Standard finalization, whether it is HVDC or few other projects for power evacuation. So definitely the cycle is turning up for next 2-3 years in that sense. Um, at the same time, if you see, these companies also got orders from international market, especially Middle East market, where there were long-term capex vision plans in Saudi Arabia coming in, the projects coming in from for the renewables from there. So the 2-3 years of slowness in domestic market was largely also supported by the international orders. So that has happened. With respect to valuation, if you see, for me, all the electrical equipment companies where the ROCs are more than 25 and very clean balance sheets are actually commanding 40 between 40 to 50x multiple. For the T&D EPC companies, there have been challenge of margin, labor shortage, and periodically there have been challenges of execution delays and material cost going up, which they're not able to pass on in the fixed price contracts. So these challenges have not actually allowed them to have a better multiple. So I think from 15x, the companies are trading at about 20-22x. And if the cash flows balance sheet improves max to max, I think on the top end, 24-25x multiple is something which we can look for these companies. I think KEC currently is, on my numbers, might be trading at about 19-20x. So there's some room where the multiples can improve a bit, but that is subject to the cash flow improvement, which we are expecting, and the balance sheet improvement, which we're expecting.
All right. Well, point taken, Amit. Thank you so much for giving us all that insight with respect to the company. Of course, we in fact look forward to post some of these questions with the management, who in fact is with us right now. So we do have Vimal Kejriwal. He's the Managing Director and CEO of KEC International, who joins us on the show right now. Mr. Kejriwal, good afternoon. Thanks so much for taking the time out and speaking to us here on KYC. Mr. Kejriwal, firstly, I want your view on capital expenditure in terms of what is in store from an India point of view. How does that translate for KEC International in terms of order flows for the second half of this financial year? And of course, we know that the second half usually tends to have a higher order flow. That's because of seasonality. And what would that mean for the company? What is your expectation in order flow? And also, if you could give us an idea about your overall execution for the balance of this financial year.
Good morning, Agam, and thanks for having me. And I was watching what you were showing.
Okay, I believe we have a patchy line. We'll try and get back in touch with Mr. Kejriwal. But, as I was saying, that and as Amit was pointing out, a handful of challenges out here with respect to the company. Well, we must remember that cash flows has been something of a little bit of a challenge. We are also talking margins, something that the management has in fact acknowledged that should be seen as a little bit of an improvement. We're looking at interest rate trajectory, the kind of impact that the company can see when it comes to interest rates specifically, of course, government capital expenditure, and how things can, if in fact, pan out not just for the company but also for the entire sector. And we do know that when it comes to the government, at least from the street point of view, there is expectation that it could in fact see a further improvement and an increase now that we have a whole lot of state elections behind us, as well as, of course, the general elections which also came through. Yes, Mr. Kejriwal, you were finishing the point around the outlook for order flows as well as execution.
Yeah, Agam. So if you look at our numbers, we have already got orders of 17,300 crores. We also have L1 of more than 5,000. So if you add up them, we're around 23,000. Our stated target for the year has been 25,000 crores of order intake. So I don't see any major issue in achieving those targets. As far as the capex is concerned, I don't think we have seen too much happening on the government capex. Now, hopefully, with the Q2 GDP numbers, etc., we have seen a lot of statements saying we will push the capex, etc. So, I hope the capex will go up. But if you look at our revenues and all that, we are not too much dependent on the actually the capex of the central government. Our major business is T&D, where a major client is Power Grid, and they have their own plans and their own way of raising funding, etc. So I'm not too much worried. I think where the capex could probably help us is in our water business, where we have seen a sort of a slowdown and a little bit of a payment issues, etc. Once the capex comes up, I think that should go up. Otherwise, our dependence on government capex is not that high as it appears.
Mr. Kejriwal, point taken. And even if you consider your top line, we've seen robust growth over the past few years. Naturally, this is because of the fact that you've had a very strong order book, which continues to grow. And because of that, this has resulted in some very strong execution as well from your end, which hasn't been lacking at all. But Mr. Kejriwal, to a certain extent, there are some queries around, one, your operating margins, where, if I'm not mistaken, you aim to put your operating margins in the 7% bracket. So far, it's been around 6%. And also, there's been some questions about the company's inability to pass on higher costs in terms of project and pricing. So if you could shed more light here.
So Agam, we have been around, I'll say between 6 and 6.4% for the last couple of quarters. And we have very clearly said that this year we expect to end up above 7%. So that's one part of it. And we have also said that next year we should be between 9 to 10% of the margins. So I think margins, we are pretty okay now. We are looking at our order book and the margins on our order intake, and also the tender pipelines and the competitive scenario. As far as the issue of passing off cost increases are there, I think that was primarily, I'll say, a factor of COVID. There were many projects which we had started, which we had looked at when the COVID has started, and then the order pipelines, I'll say, dried down. So we took some projects by the time the metal prices had gone up. Otherwise, typically what happens is the day you take the project, you go and hedge everything, which is what we do now. So I right now don't see any significant impact or inability to pass on our cost increases. So I think we should be quite okay with whatever we are quoting and the margins going forward.
Mr. Kejriwal, I'm assuming that you're comfortable with your current debt levels, of course, notwithstanding the short-term debt that you have raised in order to fund your working capital. But in that, there was also investor interest in whether or not you are seeking to reduce debt even further. Under what circumstances can that come through? Any targets that you have in mind here?
So Agam, I think there's a little bit of a confusion. We did not raise any debt to reduce our working capital. We actually did a small QIP of roughly around 100 million, and we raised around 800 and odd crores, which has been used to repay the debt. Yeah. So clearly, to that extent, our debt will go down. I don't expect the debt to go down further because we are growing at 15%. If you look at the last 3 years, our CAGR has been 15%. This year, again, we're talking about a 15% growth, and with the sort of order book which we have in the tender pipeline, I'm sure we'll grow by another 15% next year. So I don't expect the debt levels to go down, but the interest as a percentage of revenue, which is 3.3 or so odd, I think by next year end, we should probably be around 2% of, revenue. So I think that's the way it will happen. The debt may not go down, but the interest cost as a percentage will definitely go down.
Mr. Kejriwal, that's exactly was my next question, but you have addressed it because it actually comes down to the impact on profitability. And of course, if your interest rates do go down, in that case, if your profitability will also improve. My final question then, in that case, is to do with cash flows as well. Can you give us an idea on how things are faring in FY25 so far, and what sort of cash flow statement can we expect towards the end of this financial year?
So we are very clear that our cash flows will improve as compared to what was there in FY24. A couple of reasons. One is obviously the margins are going up. The turnover is going up. So as a function of that would be a better cash flow. Also, we had some monies in Afghanistan, so we have received a lot of those monies. There were other monies which were, in some of the older projects from ACBs, etc. Those have been coming up. Thirdly, our larger order intake and execution this year is from India, Power Grid, etc., where the payment terms are relatively pretty decent as compared to others. So we do expect that our net working capital, which is somewhere around 122 or 123, will come down to 110 and maybe next year to 100. We do expect a lot of cash to be released from our working capital, and we will definitely have a significant amount of free cash flow at the end of this year.
Fair enough, Mr. Kejriwal. We'll leave it at that. Thank you so much for joining us and, well, giving us so much more clarity with respect to some of those critical areas as well. We wish you the best for the future. Of course, for now, KEC International continues to, in fact, make a new life high right now as we speak. So at least the markets are very sanguine about the outlook of the company. But on that note, it's a wrap on this edition of KYC. Lots more land up on the other side. Stay tuned to NDTV Profit.